Here. Okay, let me just pull this. Alrighty. Warm welcome to you all. Before starting officially, I would like to tell everyone, if you guys are comfortable on turning on the video, please do so. We'd love to see your face, but no pressure. And a heads up, this session will be recorded and will be there in few weeks on our YouTube channel. Give me a thumbs up if I am audible, I'm clear. I hope I'm clear. Anyone would like to speak?
Yeah, sound good.
Yes, you are.
Okay, thank you. So yeah, thank you everyone for participating in our monthly session. A quick introduction to myself. I'm Aachal Thapa, Vice President of NWiC, leading the NWiC Educate session and designing stuff that you see on our social media. Besides that, I'm currently working as a software engineer. So if you guys are new, let me tell you about our Educate program. So despite the fact that we are a group of women in tech field, we are taking an advantage of this platform and conducting this session called NWiC Educate, which is a monthly session simply to create awareness among people, especially youth, about the social issues or any topics which needs to be addressed. So we firmly believe that discussing social issues in everyday life helps create awareness and better understanding of problems regarding their exact nature and causes. However, this time we are doing something new. First, it's not a social issues. Second, it's not in Nepali. So we used to, do sessions every month in Nepali mix, like English and Nepali mix, because we are talking about Nepali, the social issues that are going on in Nepal, and we are targeting the Nepali audiences. But this time it's not in Nepali, and we are not just targeting to our Nepali audiences. So as the title says, we will be talking about stocks. To be honest, I don't know much about stock, but I'm really excited and I'm like looking forward to it, and I hope you all are too. I mean, definitely, like, you guys have signed up for this session, early morning at 7 a.m. for folks at Nepal, and people at USA sacrificing their Friday evening with us. I mean, unless you have plans after this. So yeah, I mean, thank you so much for participating once again. I won't take a lot of time. Let me just introduce our speaker for the session, Ankit Agarwal. So he's from India, currently residing in Seattle, and this time, just I'd like to say it again that it's not just for Nepali audiences, and because we have participants from many cities and time zones. So yeah, I won't take a lot of time again. Ankit, thank you for agreeing to be the speaker for the session. I don't want to mess up things, so please, the floor is yours if you'd like to introduce yourself and present about Stocks 101.
Thank you, Aachal. So this is, first of all, like when he talked a little bit about this, what you guys do out here, I was pretty impressed. I think this is great. Meeting together, sharing knowledge, and just generating awareness among each other, and that's like having that sort of a support group is amazing, right? Because you guys can help each other move forward. So thank you for inviting me to this session and letting me speak about stocks. This is something that I'm very passionate about. I've been trading stocks and a lot of other derivatives for the last 10 to 15 years, and I enjoy it. I do that in my personal time quite a bit. I talk about it, I go to meetups, and I've not stopped learning. I just look forward to trading every day. So, uh, sharing some knowledge and information here with you guys, I'm excited to do so. So, a lot of folks who are joining early morning or late in the evenings here, appreciate you guys taking time and listening to a rather boring session of stocks, but I'll try to make sure that you guys at least get some knowledge out of it. So here, let me share my screen real quick. Oh, looks like you might have to give me permission, Aachal.
Oh yeah, Shreya. She's the host of the session. So Shreya, can you give him the permission?
Try it again. Okay, there. Okay, try it again.
Are you able to?
There we go.
All right, let me know if this looks good to you guys.
Mm-hmm.
Okay. So what I'm gonna do here is I'll keep things very simple. I'm not gonna get into too many technical details, and I'll keep it fairly generic, even if I give examples that are based out of the US stock market. These concepts and how some of these technicals work would apply to all the stock markets. There might be a little bit of regulation changes here and there, but that shouldn't impact what we're speaking about at this point. Okay, so one important disclaimer, just because we're talking about stocks, we're talking about investment, we're talking about our personal money, this is purely for education only. Everything that I'm speaking of is just to generate some awareness and share my opinion. This is not a recommendation to go buy stocks. Investing in stocks is risky by nature. So uh, please do your own research, but this is purely educational. So I just have to say that, but all right, now let's get into it. So in to keep things simple, a stock is just part ownership of a company. So think of it this way. If you have a small business and you want to grow that business, you need investment. So, say you've maxed out your investment, you do not have any more capital. What are you going to do? You'll either reach out to friends and family, and then you'll bring in some money. And at that point, what you do is you would let them know that, hey, I will return this money back to you by this date and I'll pay you so much interest. If you have good family, then you just get the money and you just return, you don't pay interest. But in an ideal world, what happens is you get that money and then you set a certain time frame and then you pay interest. That's on a small scale. But imagine if a company needs to grow quite a bit, a lot of capital is needed, especially if you want to become a global company. Oh, and at that point, what happens is the company would hire investment bankers and then start working with various firms to bring in capital. That's again, not to get into too much detail, but once there's an IPO process that it goes through, and it brings in capital from some of the larger firms. And after that, the company becomes a public company and starts trading on the secondary market, which is called the stock market. So I wouldn't worry about like the exact process of how that happens, but basically a company um, starts issuing certain number of shares, and then those shares start trading on the secondary market, which is the stock market. And that is when investors like us can go buy and sell stock. So okay, so that is a stock. But then how does that make money? So when companies starts doing well, they earn some profits, they increase their revenue year over year, quarter over quarter. At that point, their stock value fluctuates. So if the company is doing well, the stock price will appreciate. And that's when you and I as an investor will make that money. We'll see that difference in the stock price. And say if the company is not doing so good, then the price is reflected. Um, and the company also shares certain dividends. What are dividends? If the company has, say, example, company like Apple, when Apple sells a lot of their products, they have some cash that is, they're sitting on. At one point, they had more money than the Federal Reserve of the United States, right? But what they do is they want to make sure that they reward their investors in terms of dividends. So every quarter, when they come out with their earnings, and what I mean by earnings is um, every public company has to go through certain process. Every quarter, they have to report how much money they have made in that particular quarter, how much revenue. So this is just public information that comes out at every quarter. So based on how well they've done, the board of directors of that company decide to give out a dividend, which is sort of just a reward to the investors saying that, hey, you guys have held our stock for so long, we're just going to pay you some money. It can be 1%, 10%, whatever amount. But in general, the price of the stock fluctuates quite a bit, right? And that is just because it's an auction. So what I mean by auction here is if someone on the other, if you have to buy a stock, say at 100, there's someone else on the other side who has to be willing to sell you that stock at 100. That's when both the criteria is met, and then there's an exchange of the stock that happens. So in general, that's kind of how because of this auction that happens at a pretty high volume, the price of the stock fluctuates day to day. And most of these public companies are, not most, all of the public companies are heavily regulated, and they are governed by various agencies, third-party agencies that make sure that companies are reporting all the information that they're supposed to. There's no sort of malpractice going on, and to a certain extent, they're liable to the investors. Okay, I'm going to spend a little bit of time to just to talk about like why should we learn about stocks? Why is it so important for just folks like us to spend some time learning about it? Say if you put your money in the bank account and you don't do anything with it, right? So for 10 years, you don't do anything with it. You might get a little bit of interest out of it, and you feel like there is a sense of security that, hey, I'm not going to lose my money. My money is always going to be there, right? But most folks do not understand the concept of inflation. What happens with inflation is the buying power starts to go down over a period of time. And I'll share a little bit more information about that. The other thing is, once you have some capital, you want to make sure that that capital grows. You want to make sure that that money starts working for you, right? If you're risk averse, then at that point, you try to save money, and then you try to make sure that that money doesn't go down. But what's important is to realize that there are a lot of opportunities for that money to grow. So stocks are one great instrument where you could let your money grow. And the other thing is, no one else would care for your money like you would, right? So you educating yourself would help you grow your money a lot more than anyone else would kind of put in that time. So here, and this is, even though I'm showing a chart for the dollar's buying power, but this is very true with a lot of different currencies. It may not be at the same scale. Some of them are even intensive than this. But what this shows is, I'm not going to go back all the way up to 1913, but the idea is that back in the day, in the starting in the 1900s up until now, what you could purchase with $1 and what you could purchase with $1 now, there's a huge difference, right? For example, in the 1980s, you could buy 17 oranges with $1. And today, you'd probably be able to buy one or two, right? So what that says is, even though you hold on to your money in the bank, and even if you get a little bit of interest, that's not going to make up for inflation. You're actually losing money. And what happens if you actually put that money to use? When I say put that money to use, if you invest that money. So here we see that the stock market has appreciated over 200% starting 2007. And during this time, the currency has been devalued by over 20%. So what that means is, if you had $100 sitting in the bank from 2007 up and if you try to use that $100 right now to buy something, the purchasing power of that $100 is down, and it's basically worth only $80 right now. But if you would have invested that money in the stock market back in 2007, that money would have been $242 right now. And I don't know if most folks are aware, but this also covers the recession that the US market had seen in 2008. So there was a financial crisis in 2008, and the effects were felt across not just the US, but outside in other countries also, because the financial markets of US are pretty tightly integrated with other countries. And then that kind of brought down a lot of financial institutions throughout the world, because a lot of folks lost their jobs and people declared bankruptcies. And even though during that time period, from 2007 up until 2000, like mid 2008, the stock market had corrected over 40%. But look what happened after that. Like 3 years later, the stock market bounced back to where it was prior to recession. And then from that point on, it's up 220%. Okay, so investing in stocks is risky though, right? So even though we see that we need to learn about stocks, why is it so important? We need to beat inflation, but investing is risky. That's true. Here, I'll just show you guys an example. So here, what I have is this is the S&P 500, which is 500 of the biggest companies here in the US, right? And the time frame here that you're seeing is 3 months. So the fluctuation that we see here is about 15% over 3 months. So say at the beginning of the month, you invested 100,000. A month later, you lost 15%. And then at the end of 3 months, you're back to where you were when you started. So as an investor, when you look at the market on a day-to-day basis, you get emotional, you get caught up, because that's your hard-earned money. You're looking at that go up and down, and especially if it goes down 15%, you panic, you get emotional, you wonder, like, I shouldn't have done this, why did I do it? You start questioning yourself, right? But now, look at this shaded area down here in the bottom left. This is the same image that I have in this slide, but now I'm just kind of zooming out. So instead of those 3 months, now what we're doing is we're looking at about seven to 8 months worth of data. What happened? Even though that the market had these crazy volatile sessions and it fluctuated 15% up and down. At the end, like right now, the market is up 25% from that point, right? Let's zoom out a little bit more. So here is the shaded region again that we saw back here. So this region, so you'll see, so what I'm trying to tell is if you are involved in the day-to-day, you keep looking at the market every day, it is a volatile market. It gets risky. That is if you are trying to make money every day. But then over a period of time, even with the recession that we're seeing down here on the bottom left, what happened overall to the market, right? It's still up over 200% in the last 15 years, right? So that's the key takeaway, and I'll talk about like strategy of like why this is important. Kind of the same thing here, just that I touched about the currency. So the Nepali rupee back in 2008, if you were to convert a dollar, you would have gotten 63 Nepali rupees. But today it's 115 Nepali rupee. So what happened is the the Nepali currency has devalued with respect to the dollar by almost 50%, right? So your buying capital, your buying power with respect to the dollar has reduced quite a bit. So when I hear a lot of folks say that, hey, if we can send money to India or Nepal and get a lot of interest, we'll get 6, 8, 10% interest. It's true. You'll get that interest, but what's happening is the buying power of that overall is still going down with respect to other currencies. And US dollar is still the reserve currency. That means throughout the world, US dollar is used as a standard to trade, right? But it's just trying to make a point about over a period of time, if you do not make your money work for you, you are losing money just in terms of devaluation. Okay, so we understand just some basic points about what's a stock, right? And then why should we care about it? Why is it so important for anyone to learn about stocks? How do we get started? So there are a lot of details, like right now with technology being at the forefront, we do not have to worry about a lot of things. We have access to online brokers in any country. All we do is open an account with them, just like you would for a bank account, right? You go sign up, you open up your account, you deposit some money, and then you are good to go. What happens behind the scenes is stocks are traded on certain exchanges, and these exchanges are, again, governed heavily. And what they do is they let that auction process happen in a fair way so that there's no market manipulation. There's a lot of transparency. So so all that bidding that happens, like you want to buy or and someone else wants to sell. So all of those orders are basically sent via your online broker to the exchanges, and that's where all of these transactions are finalized and completed. And there's a track record of everything so that nothing gets missed. So to keep things simple, don't worry about like what happens in the background. We go open an account with an online broker, you deposit some money, and you're good to go. You can start trading, right? Okay, so now you have money in an account. What do you do next? Should you just go buy anything? Okay, so there are a few different things that we could do, right? First, think of what are the products, the services that you like using, that you have been um, sort of a loyal customer to a certain company, and that you recommend over and over again. So like if you go to a restaurant and you really like their food, and you keep telling your friends like, hey, this restaurant's really good, you should try it, right? So what's happening there? You know for a fact that that place is good, and then more and more people find out about that place. That place keeps staying busy. They keep making money, right? Kind of the same thing with a public traded company here. I have certain companies down here at the bottom that we come across. Um, so like Zoom, right? We're using Zoom right now. The price of the Zoom stock has gone up 350% in the last 5 years. Kind of the same thing with Microsoft, Apple, Amazon, Walmart, Netflix, Facebook. Some of these companies were pretty familiar with, right? We use their products, we use their services. Um, and again, like these are some of the bigger companies, global companies, and there might be certain companies in India and Nepal that are kind of operating at the same level. Like maybe not in terms of the capital and their presence throughout the world, but some of these companies continue to do well because they have good products and services, and they continue to grow. So you want to look for companies like that you have been using for a long time and you continue to recommend. So that is individual stocks. And say if you do not want to get into that, what is the other thing that you can do? You can trade a basket of stocks. So what a basket of stocks means is, instead of trading one single stock, you will have, say, 100, 500, 1,000, 2,000 stocks. Those are called index funds, ETFs. So there'll be one ETF that you would be able to buy that kind of covers or invests in those 100, 500 stocks. So that kind of takes some of that risk away, and you don't have to individually go pick. So if you say if you buy like a technology ETF, that ETF might already invest in companies like Microsoft, Amazon, or just any technology company. So that's one way to do it. And then the other thing we could do is we can invest in mutual funds. So mutual funds are kind of similar to index funds, but there is someone who's actively managing those funds. What happens there is, so there's like an investment firm that manages a certain amount of capital. Just let's just say like $10 million. They're managing that, and they actively look for different opportunities. They are the ones who will go pick those individual stocks, and you just put money into that fund, and that fund gets personally managed by someone, and you get charged a little bit. There's certain fees to it, and if based on the appreciation of the entire fund itself, you might get charged a little bit. But then again, that kind of takes away a little bit of that, uh, I guess, that the work or the diligence that you have to put in, right? Or the other thing that you can do is you can just kind of diversify based on certain sectors. You know, you can put a little bit into telecom. If you know that utilities are always needed, utilities are a pretty safe bet because everyone always needs gas at the gas station. They need electricity, right? So you invest in some utility stocks, and you know that technology is always going to keep advancing. More and more investment keeps flowing there. You'll invest into that. So there are a few different sectors that you can kind of look at and start diversifying a little bit there based on the sectors. So some ideas on how you can invest your money, right? But if you want to you want to be more involved, you want to do things yourself, then there are a few things that you can start doing, like just kind of educating yourself a little bit. So fundamental analysis is essentially looking at the company's their earning reports, you look at all their documents that they publish about how they are doing as a company. What is their revenue? What is their sales growth? How many monthly active users do they have? What are their new products that they're coming out with? How much cash flow do they have? So there are a few specifics that every company has to report that I mentioned earlier as well. So you can start going through those statements and look at, okay, does this company have a lot of debt? Is the revenue increasing? Are the sales increasing? Are their profit margins increasing? Is their overall revenue increasing? Are their expenses coming down? So you can look at that information, and that information, when you start analyzing a stock that way, it's called fundamental analysis. And then what is technical analysis? So here, I'll give you an example of technical analysis. So you can use various platforms to do this. All you need is there's some few free websites. I've also put some information, the resources that I'll share. But essentially what technical analysis does is you're kind of looking at certain different things. You look at volume, you look at resistance, you look at support zones. There's certain concepts behind technical analysis where you're thinking that I don't want to look at all the financial documents that the company publishes. All I care about is what's happening with the price, because everything at the end of the day gets reflected in price. It's just a methodology, right? So with anything, you'll have to spend some time, kind of educate yourself, saying that, okay, if I have to use this sort of an analysis, what does that entail, right? But just to give you a little flavor of it, you'll start looking at stock charts, you look at their volume, you look at simple things like their moving averages. So things like that will sort of help you with your technical analysis. That's what it means, really. Okay. Well, so when it comes to the time frame of investing, when it comes to how much you want to invest, of course, these are certain things that you'll have to decide as to what makes sense for you. But some of the things to remember is you do not want to invest money in the stock if you need that money in the next month, 2 months, 6 months. Ideally, you want to invest this money for the long term that you would not need for the next 3 to 5 years, right? And some of the strategies could be you put a little bit every month. So you kind of divide up the money that you get every month, and you create chunks out of it and say that, hey, this is my expense, this is a little bit of my buffer, these are the things that I need for sure, but maybe 200 every month I do not need, I can put in my savings, right? And you can put that money into the market, like 200 every month, and for a fact that you're not going to need that money right away. So that's kind of what you want to do. So this is probably one of the most important slide, and if you see that I have a lot of points here, and there's a reason for it. So stock market investing can be very risky, but then there are a lot of people who've also gotten away from their job, and that's just because they make enough money from the stock market, or they're able to make enough money to sustain a certain lifestyle that they want. And the way you can do that is by knowing the risk and managing them in the right way. So talk a little bit about this. So first thing is, you do not want to invest everything where it keeps you on the edge, that it won't let you sleep at night, right? If you become a short-term investor, like a day trader, you see the kind of fluctuation. I showed a slide earlier where you saw that things can change like 15, 20% in a pretty short time frame. So do you have the stomach for it? If not, you want to be a long-term investor, right? You want to spend some time. You want to, it's like honing any other skill. You want to educate yourself, you want to practice it, and you want to do it in a way where you're not putting your hard-earned money at risk, right? There are a lot of people out there on Twitter, Facebook, or any social media platform that you'll probably see that they're talking about a certain stock. Just because they're talking about it, or your friends and family say that, hey, this is great, you shouldn't invest in it. You need to go look at things yourself. If you don't understand it, don't do it. There's certain people who always look for the next shiny object, thinking that this stock is going to go up 100 times. Like they're trying to make a quick buck, essentially, right? One thing that we need to understand is that investing is, we need to make it as a business. So say if you are operating a business, do you want that business to be super exciting and exhilarating where you're making 100 one day, next day you're down to 100? No, you want to make sure that there's a slow and steady increase. So that's what I mean by make it boring. You don't want adrenaline rush when you're investing. You want it to be simple, boring, but at the end of the day, all you care about is you're making some money. That's it. And you want to diversify. So that kind of manages risk, because say if an oil tanker goes down in the Middle East, the oil sector takes a hit. But if you have your money diversified, that a part of your portfolio might take a hit, but the other parts might do good, right? So it kind of balances out, but over a period of time, things get better. So just to make sure that if you put 100% of your money in one sector, it shouldn't be like you basically have a bad day where you're completely wiped out, your account's completely gone, right? So that's the reason to diversify. FOMO, that is fear of missing out. So there's one thing about the market, sometimes you look at a certain stock and you go, if only I had invested in XYZ last week, I would have made 300, 400, 3,000, whatever, right? That sort of a thought process will always be there, but the fact that the stock market provides opportunities not in 1, 10, but in hundreds and in thousands. You can miss out on an opportunity, but you will find another opportunity. So just because you missed out on one, you shouldn't continue to chase something and try to get back. So that fear of missing out, where you're like, oh, if I don't do this, I might not make money. That is a very bad, very bad practice. So this is when you start trading, you'll kind of learn a little bit more about yourself, about your emotions, and like how you control that. So just remember that there is always going to be an opportunity. Just because you missed out on one does not mean that it's over. There'll always be another one. Hedging might be a little bit of a sort of an advanced thing, but essentially what that means is, so back in 2000, this is like the dot-com bubble times. There were a lot of signs, a lot of indications that something was going to happen to the stock market, right? And the reason is, the moment a company put .com in its name, the stock would go up 100, 200%. So that's when you know that there's some irrational behavior going on in the market. So at that point, certain strategies where you can still make money, but then to protect yourself, what you do is you have a hedge in place, which just means that if the market starts going down, you'll make a little bit money from the market going down. So not to get into too much of that, but that's available. That's an option. So like I mentioned, the online brokers, they have certain platforms, and one of them is the one that I was kind of showing here. This is from TD Ameritrade, but in every country there are like tons of different online brokers that give you certain platforms to trade, even if it's just their web version. But they some of them have trading of paper money. They'll give you an account. What that means is that this is not real money, but it'll allow you to just go get a feel of it. You'll buy something, you'll sell something, you'll see how things move around, get yourself familiar with the platform, get yourself familiar with just trading in general. You can figure out some strategy, you can test your strategy, saying that, hey, if I keep investing so much every month, what is my return on investment at the end of the year? You can do things like that. So that is learning to trade using paper money, just fake money, really. So kind of continuation of that a little bit. I've seen this happen quite a bit with a lot of friends and some of the folks that I interact with. I do mentor a lot of folks when it comes to trading financial instruments, and no matter how many times we talk about this, it's just human psychology. People fall for it. So some folks get into the habit of speculation, which is they're trying to make a quick buck. They get into options, which are derivatives. Just there's certain things that you can do with the stock market where you can make 10 times, 100 times your money in a quick span of time, right? But then that also means that you're taking a lot of risk. So just basically just throwing money at the stock market. The other thing that a lot of people do is they get their knowledge from news and social media, and that's all they do. But what they don't realize is that that's just there are people out there who are just talking about a certain company. That does not mean that they know what they're talking about, right? So you cannot put your hard-earned money on a stock just because someone else is talking about it, right? And competing with others, your friend says that, hey, I made 1,000 last month in the stock market, and then you take a little bit more risk, you try to beat them. There are a lot of people online that say that, come to me, like take my coaching classes, I'll teach you how to make 30, 40, 50% or 100%. But the fact that if these market gurus have not been able to consistently make 20% a year, if you look at a track record for 10 years, that says something. So even the best of the best folks out there cannot consistently make more than 25, 50% year over year. You might have some good years, you might have some bad years, but whenever someone tells you that I can teach you how to make 100%, 200% of your capital, stay away from them. The other thing is, kind of touched up upon this. If you do short-term trading, there's a chance that you could lose a lot of money. So kind of stay away from that is what I recommend. Okay, so we've talked a lot about stocks, right? We've talked about what are some of the strategies that you could use and what are the risks associated with it and how you can manage that risk. But you also want to know a little bit about what are the other opportunities for you to make money, right? Or make more money from your money. So gold or certain precious metals have always been sort of a go-to for the last 50 years, 80 years. But these, like, I didn't pick up all the numbers, but you can do a quick check, just like I've done for the stock market over the last 50 years of how it's gone up. And I'll show you another chart here, which is about just real estate prices. But you can kind of look up the same thing for gold. And then you can invest money in your own business, right? That is another way. One other thing that folks do is real estate. Either you have your primary home, and then on top of that, you could get into like rental investment. So you buy a property, you rent it out, and then um, you can also buy like commercial rental, right? Where you buy maybe like a small office space, or I guess just any other kind of store space where another business will come and rent it from you, right? Each of these sort of ideas has its own drawbacks, and like how involved you need to be in that. When it comes to like a rental, you need to be quite involved in that process, that you need to know a lot of different things. Real estate is not so easy to get in and get out, and what I mean is, like for a stock, you can just, by the click of a button, you can buy and sell and you're out, right? And nowadays trading is free, you don't have to pay anything. But when it comes to real estate, it's not the same. There's a lot more hassle, right? So there are bonds. Bonds don't make as much money, but some of them are backed by the government. Some of them are corporate bonds. Again, like just another option. These days, there's a lot of craze of cryptocurrencies, right? So if folks are following, you see that that's a pretty volatile instrument as well. Um, and you can just leave your money in your savings account. That will fetch you, if in the US, I think it's less than 1%, but in India, I think it's like 3% or 2%. And then I don't know how much is it in Nepal, but I'm guessing that just based on the inflation of the country, the savings rate kind of changes. You can do certain fixed deposits, which are long-term deposits, relatively long-term, where you get a fixed percentage for how long you leave your money in there. So this chart just shows how the real estate prices have kind of changed over the last say 50 years or so. So if you're looking at real estate as an investment, you can get a sense of how much you can expect your money to or your property to appreciate, right? And this is like one of the comparison that you can do with stocks. Like with stocks, can you expect 10% a year, 20% a year? Like what can you expect? Versus real estate, it's basically, I think it comes down to like 3% a year, I guess. But uh, definitely look into those numbers. Okay, so just to kind of wrap things up, what I would say is that set some goals for yourself. Think about like, okay, how much of money can you put aside every month? And what are you looking for? Are you looking for just beating the inflation, which could be like 2%, 3%? Or do you want to make a little bit more than inflation? Right. And how much are you comfortable with? If you think you're going outside of your comfort zone, you want to define some of these things yourself, right? And then you'll create a plan for yourself saying that, okay, every month I'm going to put so much money aside and I'm going to follow these trading strategies. And you want to stick to that. Make your investing boring. That's the only way to make money. And to help with that, there are a lot of different educational services. There are certain educational services that only give you ideas. They don't make money by you buying and selling them. They just they do the due diligence on your behalf. They tell you that, hey, these companies are good. They've been making money, and the potential in the future that they will make more money is pretty good because of these reasons. So you can go and start with that list. That's not a bad place to start. Um, you need to have a long-term focus. You do not want to look for day-to-day fluctuations, try to make a quick buck. You might make, but then can you consistently keep that up? That's the point, right? And then if you're not comfortable with individual stock picking, that's fine. There are a lot of other ways to do it. You can look at the ETFs, you can look at mutual funds, a lot of different, like the sector-based ETFs. So much you can do with that. And I have some resources, some links here. Any of the charts and information that I've presented so far, they these are the links that I've used. And the last link, the finviz.com, you can use that for your technical analysis. That's a free charting website, and it provides you essentially any information that you would need. So with that, I am going to stop sharing my screen. I know that I probably talked quite a bit about a lot of different things, and if there are questions, we can start going through them.
Yeah, thank you so much, Ankit. So yeah, I mean, definitely, if you guys have any questions, please, feel free to unmute yourself and ask Ankit the questions. But before that, I'd like to address some questions that we got from our Google form responses. I'm just gonna see like whoever has joined the video, and so I'd like to start with Jasreen Kaur's question. So the question is, what kind of fluctuation is normal in the stock market?
So it depends. Just like I kind of showed earlier, if we look at a certain stock, some stocks are more volatile than others. So, for example, if you look at Tesla, Tesla can move a lot, right? As compared to, say, a stock like GE, which is General Electric, which is a big company, has been around for a long time. And so it kind of depends on that. Um, but if you're looking at just the big companies that have been well established and have been around for a long time, they kind of move with the market. So about 10 to 20% is pretty, like, even if they correct 20%, that's pretty normal. But you will not see them go down to like go down by 60, 70%. That's not normal. So it just kind of depends on those categories of stocks.
Okay. Yeah. So just a fun, vague question, okay, Ankit. Is now a good time to buy a stock?
Well, so the strategy that I kind of talked about a little bit,
Uh-huh.
I would say that you will never know, right? No one has that crystal ball that is it should we invest now and then from tomorrow it'll keep going up. You'll always have those fluctuations, right? But overall, the way I think of it is the are people making money? Are there jobs? Are the jobs, people getting better jobs? Is there more focus on infrastructure? Is there more focus on, like, are people spending more money? That means they're making money, right? So overall, you got to start getting a sense of how the economy is doing. Are people losing jobs and they're not able to make their car payments, their home payments? That should give you a sign that something's happening, that the economy is not doing so good. But look around you right now. I think right now things are pretty good. I know that we're just coming out of a pandemic in the US, but then elsewhere, things are still pretty rough, right? But then considering all of that, I mean, I guess just speaking to the US, I feel like things are starting to get better. Things are opening up. The economy is opening up. People are getting out. They want to travel. They want to spend money. They've been home for the last 18 months or so. They haven't done anything, right? So what happens at that point? When the money is spent, businesses make that money. So when businesses make money, stocks go up, right? So that's I can't tell if you should invest or not, but I'll kind of share my opinion of what I'm seeing, right? And I'll say that what I'm doing with my money, I every time there's been a dip in the market in the last few months, I have been buying because I think that the market has a lot of potential, especially with the just the economy opening up, right?
Yeah, I mean, definitely there will be a list of considerations that may seem daunting, but I feel like, yeah, all of these questions, and there should be a proper research and everything before investing. So yeah, makes sense. So we have another question. If that's not relevant to your experiences, please let us know, Ankit. But we have this question from Anish that says, "Are there any limitations for investing in stocks in the US while on F1 visa?" If it's not relevant, please let us know.
Oh, no, I when I when I was here on a student visa, F1 visa, I was trading. So
Okay.
the answer is no. There's no restrictions. You can continue to make money. You can trade every day. You
Mhm.
know, as you want. The only thing is when you file for your taxes, just make
Mhm.
sure that you're not selecting that you're a stock trader. As long as you file your taxes as just a uh, I guess a regular individual, and you're not filing it as a full-time stock trader, you're fine.
Okay, that sounds interesting. Yeah, so we have another question, just one question now. Then after that, anyone can, unmute themselves and ask. So, any differences, similarities between crypto and normal stocks?
Well, when it comes to trading,
Mhm.
it I would say not a whole lot. Like I'm guessing. So the question, I don't, if the person who asked that question is on the call right now, feel free to just kind of correct me if I'm going down the wrong path. But if you're talking about trading both of them, I would say not so much because it's just like buying and selling an instrument.
Mhm.
And the one thing is trading crypto can be a little expensive because not there are not many platforms out there that let you trade it for free. So like Robinhood is the one that will let you trade it for free. But when it comes to stocks, it's pretty much free these days. Like any platform will let you trade it for free. I don't, and this is one thing that I'm not completely sure. How is it in India or in Nepal? Um, if the platforms out there charge, but there's generally, or even here in the US, there used to be a little bit of a small fee for trading. But when it comes to crypto, it's true. Most platforms charge quite a bit of money to trade crypto. It's
Okay.
more volatile. It fluctuates quite a bit.
Mhm.
That has a completely different level of risk associated to it.
Okay, yeah, that was the question by Shriyal Shrestha. So we have some questions on the chat, but before that, if anyone wants to unmute themselves and ask, please feel free to do so. Anyone? Or else I can
I have a
just.
question.
Okay.
So I'm really new to stock and I've been reading news about how stock prices are manipulated, especially by hedge funds. Can you talk a little bit about that?
Sure. So, so I guess this is one of those things that the the markets have been manipulated since the inception of the market. So back in the day, stocks were pumped up, or like back in the day when it was just radios and there wasn't any social media to talk about stocks. Uh, Companies would basically talk about certain stock, pump it up, and what they would do is prior to doing that, they would buy a lot of those stocks and then they would go out to the public and start creating a buzz. So then the public would be like, oh my God, this stock is going to go up, this stock is going to go up, right? And then these companies, what they do is at the top, they would start selling that a lot. So now all these retail traders are stuck. So that is a form of manipulation that has been happening since the 1900s, like the beginning of the century. And right now, there's nothing's different. So my advice is that this will continue to happen in some shape or form. So that's the reason we need to understand the risk, and we need to make sure we are not investing in certain stocks. Like, for example, like one of the stocks that has been in focus, with this particular context is GameStop or AMC, right? Right from, if one had done some kind of homework, you would see that these companies are not making money, they're losing money, right? Would you, as an investor, want to invest your hard-earned money into a company like that? No, unless you're speculating, you're gambling, you're like, well, there's a lot of talk about this on social media, right? So this is one of the stocks that you could potentially make money, but then also you could lose a lot of money, right? So I would say the whole idea of manipulation, I agree, it happens a lot and it'll not stop. That will always be the case. The market moves based on volume. So what that means is, like, folks like us who are buying and selling 1, 200, 500 stocks, that's not going to do anything to a stock. But when a hedge fund is coming out with like hundreds of millions of shares of buying and selling, that's going to make a movement in the stock. Just it just makes a big impact. So I would say that stay clear from stocks like that, and let, let the manipulation happen. No one can stop that. That's just the nature of the game.
Okay, so we have some questions from the chat. Um, yeah, my sister Ada, she's kind of interested in stock. So her question is there a minimum amount you can put in stock?
I don't think there's any minimum. It kind of depends on that online broker that you open an account with. Some of them can say 100, 500, 1,000. But from what I know, there's no minimum. So you can just go and buy one stock of any company that is worth 1 rupee or 10 rupee, and you'll be fine.
Okay. And Suhani says, what's a good platform for beginners to start investing?
Again, I'll speak to the US just because I know few platforms here. One good thing is that right now all the platforms let you trade for free. There's no charge. Like back in the day when I started trading, it was $7 to buy, $7 to sell. But now it's free. So you don't have to worry about that sort of $15-20 round trip fee to pay for. So Fidelity, TD Ameritrade, Robinhood, and by the day, there's new platforms that are coming up. So you can pretty much pick any of them. I know that Robinhood is pretty famous and it's pretty simple to use. Like if you just want to get a sense of buying and selling, I would recommend that.
Yeah, what was the fuss about, if you remember, Ankit, like few months or few weeks ago, there was something going on with Robinhood, right?
Yeah, it was related to the same thing that Pragya asked. So what happens is that when you when an online broker, there's a certain volume that is expected to go through an online broker, and when it gets skewed in one direction, when say there's way too much volume than they expect, they need to maintain certain buffer, certain amount of money with the exchanges. So um, basically, what they were not able to keep up with some of their minimum limits, and for that they got into trouble. So what they did was they started regulating how much of trading can happen on some of these stocks where the volume exploded. Like instead of 1,000, the volume went to like 100 million. So there's like a huge difference, and they were not able to keep up with that buffer that they had to maintain. I mean, some of those technical things, like I kind of stayed away. I don't exactly know some of those technical things that happen, but that's the sense of it. So they had to just regulate it because if not, they would have had to liquidate a lot more positions to maintain that sort of a buffer.
Gotcha. Thank you. Thank you for the answer. So one more question from Hemant. What are the best book that you recommend for investing?
Ooh, nice. Um, I can get back to you on that, Achal. I can share that with you.
Yeah.
I have a folder with a few different books, and I've loaned a lot of my books to some friends. So what I'll do is I'll get back to you on that,
Okay.
Hemant. I'll share that information.
Yeah. No worries. So yeah, if anyone have any questions even after the session, I mean, definitely this session is recorded and it will be there on the YouTube. But if you have more questions or anything like that, you can reach out to us, and we can reach out to Ankit again. And if you want resources or something like apart from the one we sent you from the Google form, so yeah, we can do that. Please reach out to us if you have anything after the session as well. So yeah, we have one more question from Shubham that says, what are the factors to be considered while trading and investing on stocks? So definitely a lot, but yeah, if you'd like to specify something.
Yeah. So um, would you need that money right away, right? Like that'll be the first thing. And then the other thing is, are you putting that money in something that is super risky and volatile, or are you putting that in a good company that might make you money slowly over a period of 2 years, 5 years, or are you going to put that money into a company that has a lot of momentum that moves 20% every week, right? So I would say it kind of depends on your goal. So if your goal is to make consistent money over a period of time, then you want to first pick a certain stock based off of that sort of a risk profile. The second thing is you want to put money only that you would not need right away, that you can sort of leave it in there for, I would at least say like a year, 2 years, because if the company pays dividends, you only get those dividends once every quarter. So, you want to be able to capitalize on that, right? Um, and the other thing is, say if the pandemic comes back and the US economy has to close again, then that's going to take down the stock market. So at that point, if your money goes down again, say for a year, 2 years, are you okay with that? Or would you be okay kind of taking a loss and getting out? So these are certain things that you want to consider. But of course, you cannot account for all the worst case scenarios. But as long as you don't need the money right away, even if the stock market comes down a little bit, you can weather it out. You can kind of wait for it to come back, right? So I would say that's a good starting place.
Sounds great. Yeah. I don't remember. I don't think so. You talked about. I don't think so. It's important, but is stock something with luck as well?
Well, I mean, to put it this way, there is luck involved, right? But then it's mostly about how you manage your risk. So the thing is, when you put on a trade, when anyone puts on a trade, they do not know how the stock is going to react. Is it going to go up, down? No
Yeah.
one knows. But what makes someone successful is how you manage your risk. If you put 100% of your money into one stock and something happens where, like there was certain companies come out and they say there was some accounting error because of which there's some investigation that needs to happen into the company. And then the stock just crashes like 60, 80, almost 100% in few days. At that point, all your money is gone, right? So no one could have predicted that. But then what could you do as an intelligent investor? Not put all your money into that stock, right? Even though it's a big company, something like that can happen, absolutely happen, right? Like we heard of Enron, like back in the day, it was a pretty big company, but what happened? They faked a lot of their accounting and then they lost money. So I would say that um, you can rephrase luck in a way of, are you prepared for what happens next? Are you able to manage that risk? Because if luck does not support you, it's not in your favor, then you just take a small loss and get out to your next trade and then find a better opportunity. Or you get stuck and you lose all your money in that one trade.
Yeah. Thank you so much for the answering all the questions. So before, it's 10:30 here, EST. That is
Actually,
basically,
I have a question. Sorry to interrupt. Just one question.
yeah, sure.
Um, so, uh, so when I see a stock, like the stock price increasing, right? I have this tendency to like buy it right away. Not I won't say tendency, but like I have this desire to buy it right away. Like I believe that it'll increase more. Do you think is it a safe practice to buy it at that time, or is it better to wait for the dip?
So if it's FOMO, like the fear of missing out, where you see something starting to go higher and you're like, oh, I gotta buy in before it starts going higher, right? And again, it all kind of boils down to managing risk. Like, trust me, that one slide, I think I put so many points in there, and that is the most critical thing there. Because for any strategy, like I know friends who or like my trading peers, their strategies are super risky. So the strategy that you mentioned, you just have to figure out if that is working for you. And how you would do that is, say you invested when something is going up, right? So that is momentum. So a stock already has the momentum behind it, and you are jumping on a train that's already moving fast, right? So as long as the train is moving, if you're on it, you're good. You're making money. But at the moment the train starts to slow down, you jump. That is a strategy. So if you are able to make that work for you, and again, from the slide, I said, you create a plan and you stick to it. So this could be your plan. But the the part that goes wrong is sometimes you get in and then it starts going the other direction and you get stuck. That's when you give your money away. And it's happened to me too, where I've I keep seeing that something's going up and I'm like, okay, it'll keep going up. And then it comes back, you're like, well, I'm still making 100. It comes down. And like, well, I'm still making 50. Well, it comes down. Well, like, I'm not losing money. It's still the same price where I got in. Now it comes down a little bit more. It's only down 10 from where I got in. Before I know it's down 200. So from making a profit of 500, I'm down to 200 now, right? So that's when you know that you're not working the strategy well. So you have to define what that is and stick with it.
Yeah, that happened to me a lot. So thank you.
Yeah.
Alrighty. So if you guys have any questions before we wrap it up, because it's been past 1 hour and it was really interesting. I learned a lot personally because I had like zero knowledge on stocks. So if you guys have any questions, please feel free to put them on the chat or unmute yourself. So
One question. So,
okay.
Ankit, would you recommend something, especially for US, short-term investment? Say you just want to invest something or hold for something for 2 years, considering savings accounts are terrible over here. You don't get anything.
Mhm.
Would there be anything for short-term investment?
I would say that stay with the index funds. So the index funds that go with like 500 stocks or 1,000 or 2,000 stocks, stick with that because that will give you dividend. So even if the stock stays the same for the next 2 years, you collect dividends every quarter. That is one thing. And then the other thing is, even if the market takes a huge dip, the index funds don't go down as much. So individual stocks can go down 20, 30, 50, 60% in the matter of weeks, right? But then indexes, something drastic needs to happen for it to correct that much. Normally, indexes will come down 5, 10%. That's kind of normal. So I would say that if if you do not want to get caught into a risky situation where you could lose a lot of money, I would say invest the money in either some of these blue chip companies like Microsoft, Amazon, Google. Some of these companies, their recent earnings kind of show that they've been making good money. But I would say even more than that, it's always good to kind of stay with index funds, especially if you are new to trading, because you do not know how you'll react to it when things start going the opposite direction.
So index fund would be a safe option for short-term as well as long-term.
Yeah, yeah. I mean, you won't make as much, but you won't lose as much either if something corrects. From that perspective, for new traders, I would say that's definitely a good strategy.
Thank you.
Well, thank you, Ankit. So again, I think I'm gonna say this one last time. If you guys have any questions, please feel free to unmute yourself. And yeah, we have to, like, we're gonna wrap it up. So one last call, guys. Anyone?
So there was one comment or question, I think, in the chat about having like an advanced session, and
Oh,
that's, I guess, just up to up to the group. For me, like this is something that I enjoy. This is my passion. So you guys can, if you guys liked it, you guys have more questions, we can do another chat, or if folks have any more questions, feel free to reach out to me and send those questions to me at any point, and I can share my just my opinion and any information that I can.
yeah, definitely. I mean, I love this session, and we have like a lot of questions here. So, if we are planning to do something like that, we'll definitely know everyone in the social media, in the email you guys have sent us, in the Google form. So, since yeah, we are like almost at the end of the session. So for now, if anyone have any questions, please let us know. But definitely, we'll discuss about it if we want to do an advanced of this session. So yeah, we'll let you know. So I think yeah, just one last call if you have any questions, or else I'm gonna wrap it up. And thank you so much, Ankit. Thank you for sacrificing your Friday. So okay, I mean, you're in the PST zone, so I mean you still have some time for Friday
Mhm.
night. So right now it's almost 11 here for me in the EST, and so people in Nepal, have a good day, and thank you so much for participating. Again, if you guys have any question, please reach out to us on our social media. We are everywhere: Twitter, Instagram, Facebook, LinkedIn. So just reach out to us. And Ankit, once again, thank you so much. And we'll reach out to you if like we further resources or anything we want to share. And the YouTube video for the session which is recorded will be there after a few days a week. So yeah, thank you so much. Thank you so much, guys.
All right, this was great. I hope you guys had fun, and if there's anything, definitely reach out.